What might make you gains today may not necessarily be the safest asset tomorrow. Well, that's the theme of our discussion with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. And we'll be talking about gold. I was hinting at gold, Chris. Welcome back.
Hey, thanks for having me, David. Always a pleasure.
Crypto stocks have made a lot of people rich over the last 2 years. They've also bankrupted a lot of funds in the last 3 months. Gold, however, hasn't really done any of those things in the last year and a half. Or should I say just 1 year, but perhaps that is where you need to go right now. Perhaps what's boring is what's needed for investors at this particular point in time. I say boring because gold hasn't really done anything in the last 2 months since we spoke. Chris, what are your thoughts?
Yeah, I mean, gold's out of favor. Precious metals, miners, they're all out of favor really this year. And not a whole lot has changed in the past month or two. To me, they're kind of a dead money at this point. I think there's going to be a time when they really will shine. And we almost saw that early this year. They were starting to take over, but we saw panic selling hit the stock market, mass liquidation, and it pulled them down, which is what always happens when we see that type of selling in the stock market. Right now, I don't see them as an opportunity right now. I think as a trade, they could be really good in a month or two. So I'm just kind of watching them try to base out, because the thing is, we're watching the gold miners, and the miners continue to make lower lows, and they tend to lead the price of physical bullion. And if they're heading lower, that probably means gold is likely to flounder or continue to head lower as well. So I'm not too excited about it at the moment.
You know, it's interesting. You're telling me offline, a lot of people are heading into cash right now. Probably because sentiment right now for the overall markets is fearful, anxious at best. I wonder why people would go to cash though right now and not something like gold or even high yielding debt, for example. I mean, we have real interest rates that are still negative. In theory, your cash should yield a negative rate of return right now. So I don't know why cash is the best place to go. Well, I don't know if it is.
Yeah, so everybody's got their own view of cash, and a lot of people think it's not a position. They think you're going backwards with inflation and negative real rates. But the reality is, going to cash for a few months here and there isn't going to kill you. It's not like you're holding it for a year or two and you're going to spend all that money with high inflation. I think this time around, we're seeing record amount of cash being stockpiled. There's been a lot of talk, a lot of articles on it. And I think that's because the general investor, the masses, the big money that really continues to float the stock market naturally higher, those investors are getting really nervous. And the fact that stocks are going down, they typically will start to move and shift to bonds. But now bonds aren't acting as a safe haven. And so they don't know what else to do, because most of these are baby boomers. They have a lot of money. They don't want to move into very risky stuff. So they're just moving to cash. And that's why I think we're seeing this big stockpile. It's usually stock and bond portfolio. If both aren't working out, their next common sense play is to move to cash. A lot of people are very nervous to get into anything that's aggressive. Growth stocks have been down since more or less March of 2021. Precious metals markets had quite a pullback. So everybody's a little spooked. And I think the big money just wants to sit in cash for the time being until they figure out what do they do with rising rates, bonds falling, because it is a big shift. I don't think a lot of people can remember what it was like when, bond rates were rising, 40 years ago. It's beyond most of us.
Chris, I've learned to ask my next question sooner rather than later in the interview based on prior experiences with you. It's usually a story in its own. What is your personal allocation right now? Are you mostly into cash, like you said, of other people, or are you allocated into some other things? You've shifted your weightings back and forth throughout the last year. So I'm curious to see what your position is right now.
Sure. Yeah. So if we were to look at long-term position, so this is the weekly chart of the SP 500. And if we were to just kind of zoom into this more recent time frame, we have more or less, we got our sell signal for investing over here in March. So we've been in cash, no bonds, no stocks with our long-term investment portfolio. We're just letting this market fall and trade lower. That's from a long-term perspective. So large cap, large amounts of money, your big retirement money that you kind of want passive investing. We're just letting this market work itself out. It's a long way from kicking back into a new bull market. And the reality is we could get into something much uglier eventually that turns into a complacency rally where we see the markets rally for potentially a few months, and then they could easily roll over and eventually move into a much bigger bear market. And there'll be lots of opportunity, I think, to the downside. But in terms of large capital, long-term capital, we are 100% in cash from that standpoint. Now, if we were to look at our more active trading, this is our daily chart of the NASDAQ. And so you can see we've had some trades going up into the end of the year. We had a little losing trade here. The market rolled over. We avoided this sell-off. We had a nice little trade here in March, closed out in April, and we've avoided these moves. So depending if you're a long-term investor or short-term swing trader, we trade the markets, in these kind of waves, and we look for these signals. So we've avoided the crash, which is amazing. It's actually been a good year. The market's devaluing. It's reevaluating itself, and we've got all of our cash here sitting ready to move in when we get a new market buy signal.
I think I've asked you this before. I'm not sure, but Chris, you don't like shorting things, do you? You've avoided this correction. You've waited on the sidelines, but you haven't really profited from the downturn. Is that fair to say?
Right. So in the grand scheme of things, the stock market, based on our technicals, is in a mixed phase between a bull market and a bear market. It's not in a full-on bear market based on our analysis. Once we do click into a bear market, which could be in a few more weeks maybe, or a couple months, that is when we don't sell short. We buy inverse ETFs that rise in value when the stock market falls. So we will be taking advantage of the downside when we get into like a stage 4 decline, a full-fledged bear market. There's a lot of opportunity there.
Just a question on the inverse ETFs. How long do you usually hold those instruments for? Because from my understanding, depending on what you buy, these inverse ETFs usually use a lot of options and futures contracts to create that synthetic product. The rollover on those could erode your value over time if you just hold it, right?
For sure. So it's inverse ETFs move. They have a little disconnect between the actual price, as you just said, the way they're constructed. But a falling stock market moves very different. It has to be traded a lot differently than a normal bull market phase. So when we get into an inverse trade, believe it or not, the trades only last 5 to 20 days tops. Okay. And there's usually only a few of them, 2 or 3 of them in a bear market, because there's very rare setups and it's a volatile time. So we really kind of cherry pick when the perfect setup occurs to get into these. We're not looking to make a fortune on the collapse. We're looking to make some money and be defensive. And then when the market does roll over and bottom, eventually we'll have more capital than we did originally to redeploy, with big dividends, undervalued stocks, and a market that's ready to rally, 100% probably over the next 18 months or so, which is typical after a bear market. You can double your money with about 18 months.
Would you recommend trading inverse ETFs to a novice trader, Chris? I think this is more of an advanced trade, isn't it?
Yeah, I don't think anybody should try trading anything inverse or shorting the market. It plays tricks with your brain. It's a lot tougher than it seems, and the market falls in a very different way. You really have to be on the ball to be able to get a good entry, hit targets, good exit, or else you just give all your money back and lose. Yeah.
Also, I think towards when the options within these products expire, that they lose that the overall instrument loses value if the underlying stock doesn't change at all. Like over time, it just kind of erodes value.
Yeah, so the leverage ETFs are a little bit like an options play. Over time, if the underlying doesn't move, these things still decay in value.
Yeah,
so
exactly.
You just want to get in.
There's options decay embedded into the value. Let's talk about a bear market. You said we're not quite in a bear market yet. I'm just curious as to how you define a bear market, Chris.
Right. So a bear market, it's based on technical analysis. It's based on momentum, and more or less, we're just waiting. Like we've had that 20% correction in the stock market, which the textbook definition is if you pull back 20%, you're in a bear market. That's kind of the general vibe of things. But we're waiting for a little bit more time. We don't really consider a bear market something that happens very quickly. It takes usually several months to unfold. I think we still have a few more weeks potentially before our system will say, okay, there's been enough time passed. We're below key moving averages. We're making lower lows and lower highs. It has now lost all bull market uptrend and it is now down. So it's a time thing. These bull and bear market patterns in cycles are very large, so they don't flip very quickly. Even though we've got red on our investing chart, we had red back here during the COVID crash. All it's telling us to do is move out of our investment capital, go to cash and be protective. When we get a new bull market, we'll get back in. If we get a bear market trade, we're going to profit from the next leg down. So we're in kind of no man's land right here, just being defensive, letting everyone else panic.
All right, we're going to get back to your outlook on both the S&P 500, the NASDAQ. Well, that's two things, but the third thing would be gold, gold and gold miners. So we'll touch on your forecasts in just a bit. If you're watching this now, write down in your comments below where you think the markets will end up by the end of the year, gold and stocks. Chris, let's talk about your next chart. I believe you have a diagram for us, the 4 stages of markets. I think that, it shows various market cycles, and maybe you can explain to us where we are currently in these cycles here.
Sure. So Stan Weinstein, I read his book years ago, and I fell in love with it because he breaks the stock market down into 4 stages. And these stages happen on any time frame. Could be a tick chart, could be a minute chart, could be a daily, weekly, quarterly, whatever. It doesn't matter. The nice thing is when you can identify what stage an asset is in, you know whether it's a great investment, how aggressive you should be, or how defensive, or if you should even avoid it. So looking at this diagram here, we've got a stage 1 basing formation. This is when something's been dormant for a long time, just like on the right-hand side over here. It's usually dead money. And this is kind of right now the stage where gold and metals and miners are somewhat in. They're kind of in this stage in a short-term basis, kind of dormant. And then we're looking for stage 2, something that is rallying, that is strong, that's moving higher. And the bar here is colored green because that's where the opportunity is. When something has trends, there's a lot of money can be made. A stage 3, which I think the US stock market has been in for the past year. And I also think we're actually just starting a stage 4 here. Well, stage 3, you don't really want to mess with too much. They're very choppy. Stocks are all over the place. Usually the indexes do well, but individual stocks, most of them struggle. And so you want to avoid these times. That's why it's marked red. And right now, I think for stocks, we're coming into a stage 4 decline. I think we're right at the infant stage here of potentially a very long bear market that is going to be a huge opportunity for anyone who, if you just avoid it, it's going to be a massive opportunity. But there's also a lot of opportunity to profit from falling prices. And so the stage 2 and stage 4 is what we're excited about. And it looks like we're entering a stage 4 right now.
What do you mean by opportunity, Chris? How do you profit from that decline?
Right. So you could either use an inverse ETF. So as the stock market falls, the ETF will go up, which is what we just kind of talked about.
Okay.
The other way it's an opportunity is to literally just move to cash and let the stock market bottom fall out, let chaos take place, let everything revalue itself. And then later, when it starts to put in a market bottom, we get into a stage 1. If you're a long-term investor, stage 1 or stage 2 is where you start redeploying your capital. So you don't have to ride the bear market down. And that's the key, is just avoiding one bear market in your lifetime can double, triple, quadruple your wealth, 10, 20 years down the road. It's a huge difference in terms of how it works. So avoiding it is the easiest thing to do. You just move to cash and move in later.
Well, Chris, I think, that's what I was thinking. You should move to cash, avoid it, and then get back in when things start to look better. But that's the billion-dollar question, Chris. How do you know things are about to look better? How do you know the markets have put in a bottom?
Right. Well, and that's the whole point of our investing strategy. We move to cash with our investment strategy. You never know how far the market's going to correct. That's why our system goes red. We have to protect our capital at all costs. Eventually, the chart is going to start making an uptrend, and it's going to start making higher highs and higher lows, and it's going to show lots of good relative strength with leading sectors and indexes. And we'll get back in. We'll see our bars go green. The trend will be up. If this market continues to sell off, well, you just stay in cash. These bars could stay red for another 8, 12, 24 months for all we know. This could be a really long kind of drawn out recession, which I don't want it to be, but it very much could be. So we just follow price. That's the nice thing about technicals. Just follow the price. Eventually, you're going to have a new spot to get in, whether it's even at a little bit higher price or a much, much lower price. It doesn't matter. The key is we want to avoid bear markets at all costs. It's better to avoid them than to ride something out and get caught in it.
Okay. So let me ask you this then. which of these two strategies would you rather employ for your own trades? So let's say you assume that the stock markets will eventually bottom out and recover, like this chart indicates that it usually does. So let's say you're in stage 4 right now. You're at the tail end of stage 4 for the stock market. Would you rather get in now, Chris, and risk having the stock markets go down a little bit more, but at least you'll catch it when it's still relatively low, versus waiting for it to bottom, waiting for it to rebound? You're seeing a lot of green bars, and then you get in. I mean, yes, you're sort of getting in after it's already rebounded, but you're probably missing out on a few percentage points or maybe more in gains because it's already bottomed out. So basically, scenario 1, you're riding it all the way down. Scenario 2, you're waiting for a definitive rebound and then getting in. What would you rather do?
Right. So the answer is I would actually do both. So with the long-term capital investment like this one here, I would do your first scenario where when the bottom looks like it's getting put in place, we've seen that 30 to 50 potentially +% correction, I would start redeploying my long-term passive capital because I know I just bought it at a huge discount and I'm holding it long-term. And then we'd be looking at the shorter term chart, like our short-term NASDAQ or SP 500. This thing will turn up way sooner than the bear market, and we'll be into trades much earlier with our more active trading. So we take advantage of both time frames because you really kind of need multiple time frames to get a really consistent equity curve, manage risk properly going forward. So you get the best of both worlds by following it on different time frames.
That's really interesting. That's a key point, Chris. I think a lot of traders don't realize that the time frame really matters. So in the first scenario that I described, if you're a longer term horizon trader or investor, it doesn't really matter if you're buying things on the way down. And if you're a shorter term trader, if you're a swing trader, your second strategy, you're probably better off waiting for a rebound. I think that sums up your thesis quite nicely. Yeah, that's very important that you distinguish the timeframes there first, Chris. Generally speaking, though, are you a fan of averaging down?
No, I'm not. I don't believe in holding things falling in value. When it rolls over, I'll eventually get stopped out of a trade, and I'll let it do whatever it's going to do. I don't average down. I blew up one of my trading accounts years ago, averaging down. And you only have to do that. That was my third account that I blew up trading futures, and averaging down is a great way to really hurt yourself. I just don't do it anymore.
There are some people who, not to say that you should, but there's some people that famously have conviction in a stock or an idea so much that, let's say something goes down, they're like, you know what? My long-term value is X. Right now it's trading at, 50% below X. I don't care if it keeps going down. I'm just going to put, you hear that from Bitcoin maximalists a lot. It's like, I believe in this so much. Long term, it's going to go to $500,000. It doesn't really matter to me if it's 20K or 10K or 30K. Either way, I'm going to buy. If it goes down, I'll buy more.
I don't buy. I don't trade on hope. I thought Palm Pilot was going to be great when I bought it at 79 cents and it shot up and then it went bankrupt. So I don't care what I believe. I know the markets will do what they're going to do, and it doesn't matter what you think. So I follow price. I get out of anything going down. I'm out. I'll get back in later, or I'll find something fresh and new that's going up. It's that simple.
All right. Can we go back to your diagram one more time? The cycles. I just want to point out something here. All right, so it kind of looks like a bull cycle going down and then retracing. But couldn't you make the argument? You said that gold is kind of looking like stage 1 right now, and stage 1 in the past has rallied after the basing period ends. But couldn't stage 1 also kind of be the same thing as stage 3 in the sense that you've got a topping formation that kind of bases, and then it pulls back and goes into a decline? Could that happen, Chris?
For sure. I was actually glad you're going to bring that up because let's take a look at the gold quarterly chart, and we can touch on that in a little more detail here. If we take a look at the quarterly chart of gold, and we'll just zoom in a little bit here. Gold, it's in this scenario. Actually, the weekly chart is I think the best view here. I'll show you what I'm zoom out a little bit. So where we are with gold right now is we're in this potential, you could argue it's in a new platform. It's kind of regrouping, hopefully going to go higher, but it is also at a point here where it could be putting in a major topping phase, which is this over here, we saw 2011, 2012, huge bull market rally, consolidated in a bull flag, started to break out, and then it came back down, and then it broke down and went dormant for years. And we're actually in a very similar scenario. We've had the rally up. 2019 was the big breakout. We've had this like kind of bull flag pattern. It's kind of popped and broke, and now it's coming back down. And the big scenario is going to be here. Is this a platform to go a lot higher? Are we just starting a major super cycle for gold, or is it going to break down and have a huge devaluation event? And that's what I'm worried that might happen if the US dollar skyrockets to 120. And if we go into a bear market with stocks, the liquidation of stocks and portfolios is going to cause gold to come down. So if we go into a bear market, it's naturally going to pull gold down. And then we got the dollar potentially ripping higher, which could also pull gold down even further. So I love the long-term chart of gold. It is primed and ready for a huge rally, but we need to see it break above this bull flag pattern and get above 2000 and start muscling itself higher, because it could go either way right now. So you got to be very aware that it's in that potential stage 3 or stage 1. Either way, it's a consolidation.
Yeah. Okay. So we're definitely stage 1 or stage 3. It's up in the air right now, but what's the kicker? You said the dollar needs to move higher for gold to go down. Is there anything else, Chris, that would make you think, okay, it's either stage 1 or stage 3 breakout?
Not really. I mean, right now it's just in this pattern that, we just need to see which way it's going to break. There's always a consolidation can be seen as a stage 1 or stage 3 at any point. So at this point, to me, it feels like we're starting a bull market phase. It's been, a year and a half long consolidation. All of this is technically at this point is a pause before it goes higher. But if we get that perfect storm where equities go into a bear market, the dollar goes higher, it's going to pull gold down, and there is potential for gold to unwind, 1400, 1300, if it breaks to the downside. So we got to see which way gold breaks here.
What about the upside target for you? If it does break towards the upside, where are you expecting it to go? Where would it go?
2,600, 2,700 will be the upside for gold. None of that has changed in a year, really. The upside targets remain the same. The downside target is, that 1,300 in the perfect storm of gold wiping out the 2019 and 2020 rally.
Is it kind of a binary? It goes either toward 2,600 or 1,300. It can't just stay flat forever. No, let's not say forever. Forever is a pretty loaded word. Maybe in the next 2 years or so. Let's say the next 2 years or so.
It could very much so trade sideways. I think in a perfect world, it would just keep trading sideways if the stock market, becomes very weak and sells off. Maybe gold will hold up fairly well and create a bigger launch pad. The bigger the launch pad, usually the bigger the rally going forward. So
I see.
The longer it could trade sideways here is a good thing. Just like we saw right down over here on this chart where we saw this multi-year kind of stage 1, as soon as it breaks a multi-year stage, it goes into a multi-year rally. And so the longer this flags out here and builds the platform or creates a stage 3 or stage 1, the bigger the next leg is going to be, the more powerful it'll have when it breaks. So we just have to, this is a big pattern. It's taken a long time to play out, and it might not break out this year. So
I know you don't trade on emotions or gut feelings, but just based on the technicals here, does the momentum look more likely to pass on the upside or the downside? Just currently.
For gold and miners, I feel like I think they're going to naturally want to head lower. They might have a bounce for a week or two, but I think they're still going to be grinding lower, and they're out of favor.
And the gold miners, well, let's talk about the gold miners now. We were talking offline about how they could be a leading indicator for the gold price. Now, it's occurred to me that you've got two kind of forces tugging away at the gold miners this year. You've got the gold price itself, but also the overall markets. The stock markets have not been doing well. I wonder which has been a stronger force, because keep in mind, gold has been relatively flat year to date, even though the stock markets have been down a lot. So what's been going on with the gold miners?
Yeah, I mean, the gold miners just can't catch a bid. They continue to just see an endless stream of kind of selling. And I think we're getting pretty oversold for miners. I feel like we're kind of in this phase where it's put in its time. I think we're going to continue to see it struggle trade sideways or lower here for some time. There's a lot going on that is just making it difficult for these to go higher. I think there's going to be a great time where they have a huge rally, but right now they're clearly in a downtrend. Lower highs, lower lows. They're leading gold and silver prices lower.
Yeah.
They're just out of favor.
You know what occurs? So the correlation is very strong between the gold miners and the gold price, but the magnitude of change is completely different. Take a look at where gold, the GDXJ right now peaked at around $65 in 2020. That's when gold peaked. Okay, we understand gold trailed off a little bit since the peak in August, but gold peaked at what? Around $2,000 an ounce, and right now we're $1,800. That's a 10%, 11% decline from its all-time highs, right?
Yeah.
But the GDXJ is down 50%.
Yeah, it's huge.
I understand I understand that there's a higher beta, but that's a huge differential.
Yeah, it's given back everything. It's exactly. They're a fast-moving sector.
Yeah. So Chris, what do you think? Is it oversold now, or is it? Where do you think that maybe the sector is just, the emperor has no clothes? You take it away, everything looks naked, right? You take away the gold price strength, and the sector is just weak underneath. What is it really?
Yeah, it's a really ugly chart. I mean, there's lots of volatility, huge price gaps, huge spikes, all kinds of noise. When you look at these highs here, higher highs, and you got lower lows, it creates this kind of megaphone pattern. And all it's telling us is that volatility continues to expand. There is no real direction. You don't know if it's going to make a lower low or a higher high at any point. It's a really ugly chart. To me, it still looks bearish or sideways, probably at best, for another few weeks. It's just, it doesn't look good.
Yeah, it doesn't look good. So is it the same thesis as gold then? You're expecting a little more downside in the short term?
Yeah, I think gold and miners are going to trade sideways to lower for the next couple of weeks potentially. And then we're going to have to see what the stock market does. The stock market could either start a huge rally, which if it does start a big rally, believe it or not, I think it's going to put pressure on gold and on silver. People are going to be like, oh my gosh, we're back into a bull market. And people are going to dump their what they think are defensive plays, the gold and silver miners, and they're going to be, I want to get back into the ARK ETFs or into TAN, like the solar, or get into biotechs, which are all coming to life, by the way. They're all top leading sectors right now, rallying 30+%, a lot of them in the last week alone. So there could be a shift of everyone going, you know what, I'm getting back into growth stocks and forget gold and silver. They haven't worked again for another year. I'm moving somewhere fresh, right? So that could create more selling if we get a stock market rally.
I wonder what the correlation is between gold growth stocks and gold. That's maybe we can talk about that another time. We're both looking at the data, but I wonder if there's a relationship there. Logically speaking, you're right. There should be an inverse relationship, but I'm not sure. Finally, let's finish on stocks then. So let's talk about that scenario you just described. How likely is it that we'll see a rotation back into risk assets soon? Because remember, you did say that you were, staying on the sidelines, waiting for a potential correction, or further correction to happen. People are talking about a looming recession. So, what are the odds we'll get a recovery now?
I think this market is primed and ready for some type of complacency rally, something that could last several weeks, potentially 2 or 3 months. And I think there's going to be some great upside opportunity. We're potentially only a week or so away from getting in on a short-term strategy to play another rally move. And then we need to see what it's going to do. Eventually, it's going to get to a point where it starts to consolidate, and it either builds a bull flag and starts another run higher, and maybe we kick back into a bull market phase, or it's going to roll over, come down, and break these lows and start that, that bear market that people think the bear market's mostly over, but it could be really just the tip of the iceberg. Because this phase right here, this complacency rally is really, this rally right here. It's kind of that everyone gets in. The emotional side of thing is this complacency rally. They think it's just a pause, everything's coming back, and then we start to break down. And that's when the real panic sets in. That's when we get the real collapse, not just a 20% like we've seen now, but we see like another 20 or another 40%. And that's when the bleeding really starts. And I know they've done all kinds of stress testing on banks saying, oh, we can withstand another 20 to 40% stock market correction, but I highly doubt they can if it happens. People always overreact and sell way more, sell everything.
All right.
It creates a tidal wave. So
basically a dead cat bounce. We can expect that. All right, Chris. Very good. Thank you for your analysis today. I appreciate your time as always. Thank you for coming on Kitco today.
Anytime. Thanks for having me. Take care.
And thank you for watching Kitco News. Don't forget to subscribe to our YouTube channel and follow our channel for more content.